Hey guys, Omar Khan here from Theta Trading, and today's topic is how do we get 10% monthly returns? Is it even possible? The answer is yes, it's possible, but I'm going to tell you exactly how much risk you're going to have to take to achieve these crazy rates of returns. Because to achieve 10% a month, that is over 100% a year. That's a crazy rate of return. Now, we all know that risk is correlated with return. The more risk you take, generally the higher return you get. So I'm going to define the risk to you and so that you can understand this concept and see if it is appropriate for you. Before we move on to today's topic, if I could ask you guys a favor, consider hitting that like button if you like the videos we're creating. Consider subscribing to our channel. If you find the content to be valuable, hit that bell notification for future videos to be notified. Now, let's jump into today's topic. First of all, what exactly is a credit spread? Now, I'm going to define to you how credit spreads work. I have traded thousands and thousands of trades using credit spreads. I've made a lot of money doing it. I don't do it anymore, and I'll tell you why a little later on in the video. It's mainly because it's too time consuming and very risky. But I'm going to show you how it works, okay? Or I should say it can be very risky if you don't know what you're doing. Now, what exactly is a credit spread? Okay, so now we have the stock market as a whole, okay? So the stock market, you can buy and sell stocks. You can buy Apple and Microsoft and different banks. This is the stock market. Now, after the stock market, there's something called the options market, okay? We all know, if you're a follower of Theta Trading, you know exactly what the options market is, okay? So now I'm going to give you a couple of hypothetical trades, and I'm going to show you what the impacts are on these trades, okay? So the first trade we're going to look at is Apple, okay? So Apple currently today is trading at $166, okay? So keep that in mind, $166 or is where Apple is trading at. Now, normally what we do here at Theta Trading is we simply agree to buy Apple for a lower price and we get paid something called a premium. We get paid money for it. So for example, if Apple's trading at 166 and I agreed to buy Apple at 160 for the next 30 days, I'm going to get compensated. Why? Because I'm guaranteeing the value of Apple. I'm saying even if Apple goes below 160, I'll pay 160. So if it goes to 155 or 150, I'll pay 160. In return for that, I'm being compensated a certain amount of money. So that's normally what we do here at Theta. We agree to buy stocks we want to buy anyways at a lower price, and we get paid a premium, a lot of premium. This is called a naked put, okay? Now, what a credit spread is, and I've done a video on this before, a little over a year ago, they are a great way to make a phenomenal rate of return on a monthly basis. But I'm going to tell you what sort of risk you're going to take on to do this, okay? So here is a real life trade. So Apple is trading at 166, okay? So what I'm going to do here in this situation, if I want to achieve my 10% rate of return, I'm going to look at using a credit spread. Now, how credit spreads work is because you get paid a credit, a net credit, okay? So in this situation, what we're going to be doing is we are going to sell an Apple 150 put, okay? And then we are going to buy an Apple 145 put. And this is going to be for a duration of 30 days, okay? So between now and the next 30 days. Now, Apple's trading for 166. As long as it doesn't fall below 150, I make 10% for the month. Now, here's how that works. I will be selling these 150 options at 95 cents per option, okay? And I will be buying the 145 puts at 45 cents per option, okay? So my net credit, and that's why they're called credit spreads, is I got paid 95 cents per contract, and I'm going to be paying 45 cents per contract. That means I collected 50 cents, okay? And what is my risk? My risk is if Apple falls below 150, I'm going to lose money. I'm going to be in trouble. That's going to start eating into my returns, okay? But I've reinsured myself. I have bought puts at 145. So if it goes past 145, I lose the maximum amount of money, okay? So if it falls below 150 to 145, I lose $5 a share because what I'm doing is I'm selling a put at 150, and then I'm buying another put at 145, okay? And I'm collecting a net credit of 50 cents per contract. Now that 50 cents divided by the $5 per share that I'm risking is a 10% return for a monthly basis. Now, as long as Apple doesn't go below 150 in the next 30 days, which is a $16 buffer from where it is today, I make 10% for the month. Okay? That is a huge return. And I did this a lot in my younger days when I was trading because it was a great way to get my bank roll up, my account size up. It was a great way to make money. But here is the thing, okay? Now here's why I don't do them anymore. First of all, they are very time consuming. Credit spreads require you watching your positions on a very regular basis. When I simply agree to buy Apple for 155 or 160, I already know my defined risk. I might have to buy Apple for $5 or $10 less or $2 less, whatever I've agreed to buy it for. When you do a credit spread, generally speaking, you have no intention of owning the stock. You are simply trying to make money just by guessing direction. You're saying that, you know what, Apple's at 166. I don't think in the next 30 days it's going to go fall below 150. And for that, you're being paid 10% a month. Now, what you're risking is $5 a share. Okay, so if you do, 10 contracts, you're risking $5,000, but you're being paid $500 for a month to make that risk. Also, now, when do I like to do credit spreads? I was going to say, when I like to do credit spreads, if his stock has had a major beating, it's taken a pretty good beating, and it's a great company that I love, like a company that I really, really like. Let's say, Apple. I do like Apple, and that's not meant to be a stock recommendation. It's just saying that this is a company that I really believe in long-term. So I think long-term the price will go up. So I certainly don't mind owning it. That's why I don't mind writing puts. But in the short run, the stock market really can go anywhere. It can be affected by so many things, including and mostly human emotion in the short run. So is there a possibility for that stock to go from 166 down to 150? Yes, there is. But not a high likelihood. And because of that, you still have to kind of keep watching it, make sure it doesn't fall below 150. And if you have a day job, for example, and you're like, you know what, the stock's now at 155, and you're in a meeting, and you're looking at your phone all day long, that's not a spot you want to be in. And that's why I'm saying they can be very time consuming. Also, when you sell a credit spread or collect credit on a spread, you are permanently risking your money. Meaning, if Apple falls below 150, you start losing money once it falls below 150 and then minus your 50-cent credit. So 149.50 is your break-even point. Below that, you start losing some serious amount of money. You can lose all of your money here. If you risked all of your money on this credit spread, you could lose it all minus that credit that you got. And that's a spot that I don't necessarily want to be in. So for that reason, I don't necessarily do credit spreads anymore, but I understand. I know a lot of people who do this for a living and they make great money doing it, but you have to be dedicated to it. You have to know what you're doing, and you have to be able to monitor this on a regular basis, okay? So when I like to do credit spreads is when that stock has had a major beating. Once it's taken a major beating, and I go, you know what happens once a stock has taken a major beating? Volatility goes up, which means the amount that we get paid on these options increases. So when volatility goes up, let's say Apple were to go from 166 down to 100 and let's call it 150, and volatility is up, meaning I'm going to get paid more. Then I would go in there and I would do, let's say, a 130, 125 credit spread on the put side, and I would get paid that credit. As long as Apple didn't go from 150 down to 130, I kept that 10% for the month. That is a crazy return. And conversely, you can do this on the call side as well. So if a stock like Apple has a major run-up, and you're like, you know what, it's had a big run-up in the last 2-3 months, I don't think it's going to run up a whole lot more. I'm going to sell a covered call and then sell a call and buy a call at the same time. That's how a credit spread works. So let's say Apple goes from 166 to 185, and all of a sudden I go to myself, I don't think it's going to go to 200. And I do a 200 call, 205 call. So I'm selling the 200 call and I'm buying the 205 call. And I'm collecting, again, 50 cents. And I'm risking $5. Again, a 10% return. Now, this is very, very possible, but I just, again, want to point out to you, you're going to be watching your screen all day long. You can make great money doing it, but you're taking on risk. You're taking on that risk of that permanent impairment of capital. So, for example, if you go to sleep one day and all of a sudden you wake up tomorrow and Tim Cook has got hit by a bus. Well, Apple's shares may go down a considerable amount for a short term, and you may lose a significant amount of money. So these are all possibilities, and that's why the returns are so high and can be so tempting. I can tell you for sure, I have done so many of these trades. The last time I did it was simple. The last time I did it was It's called a flash crash in May of 2010, I believe it was. And the stock market went down about the S&P went down about 8 or 9% in the last hour of trading that day. That has never happened before. And all these positions that I thought couldn't possibly not get there, all got there. So I had a lot of money exposed. I will never make that mistake again. Now, again, if you do this for a living, this is something you can monitor, that's just taken care of. But if you're like me and you only want to trade about 30 minutes a day, maximum an hour a day, credit spreads will require a lot more time, and they will possibly, you could lose a large chunk of your money. And that's not what we like to do here at Theta. We like to keep our money and want to make, the worst case situation, we want to make sure that we have a high quality stock that we own long term. We do not want to impair our capital. First rule of investing, don't lose your money. Second rule of investing, don't forget rule number 1. It's that simple. So guys, I hope you enjoyed this little analysis on credit spreads. To me, they're a great way to make money, but I wanted to just tell you again, a lot of time and there's a lot of risk involved. But if you know what you're doing, you can make a substantial sum of money. Now, one last thing I wanted to point out to you, and I'll do a future video on this, okay? And it's called the concept of iron condors. Now, a stock cannot move in two directions at the same time. It can't go up and down. It's either going to go up or down. It's not going to go both directions at the same time. All right. So what an iron condor is, it is when you sell a credit spread on the put side and the same time you sell a credit spread on the call side. So you're collecting 50 cents from both, right? And your risk still is $5 because the stock cannot go both ways. So essentially, that return would be 20% for the month. It's a huge return if, again, you know what you're doing and you have the time and willingness to commit to monitoring this trade. So guys, I'm going to do a future video on iron condors and other great ways to look at making money. You have to decide whether these risks are appropriate for you. But more importantly, make sure you educate yourself so you fully understand what it is that you're doing, the risk that you're taking. Smart, intelligent investors understand the risk they're taking before they get into a trade. We should be no different. Guys, Omar Khan from Theta Trading. I hope you guys enjoyed today's video, and we'll talk to you soon. Take care.